gentlemen, Graeme Holm here, aka Australia's original money mentor, and it's an absolute pleasure as always each week to introduce you to the brilliant Dr. Andrew Wilson. I won't cover off his credentials. Most of you by now should know who he is and the amount of weight, his accreditations and his experience. He's definitely well versed as a talking head in the industry, and his knowledge, his degrees, his accreditation cover all of that. So let's not muck around. Well, good morning, ladies and gentlemen. Here we are, 2023, off with a bang, back with the amazing Dr. Andrew Wilson. Good morning, Doc.
Yeah, good day, Graeme. And, the year's flying by.
It'll be Easter shortly.
I know. It's, I still feel I'm locked in 2022 or 2021, whatever, but nothing much we can do about it. But there's certainly plenty to talk about, which is good, which means we're well and truly into the year now.
That's for sure. That's for sure. And Doc, there's lots to talk about this week. We've got interest rates again moving, inflation figures to discuss, rents out of control, housing prices crashing. Wow. So, I mean, geez, where are we going to start this week? Is it bad? Is it good? What's happening?
Well, I guess, it's the latest data, and I mean the latest data has come out showing that the US January inflation rate, although it was slightly better, hasn't really improved, to the extent where you'd say, well, interest rates are working. I don't think they're working at all. It's, it's the conundrum for central bankers is, what do we do if interest rates don't bring inflation down? I mean, they're still so far away from their target range. It's just not funny. And, the predictions of when this will occur are becoming, further out and further out. And I think there's going to have to be some sort of a major policy rethink, when it becomes evident that this inflation outbreak is, not going to be controlled by higher interest rates as we've seen in the past. And the big jeopardy is that if we do continue to push up interest rates, it's going to have a significant impact on our economies. And I'm not sure central bankers are ready to wear that.
And it's an interesting one, Doc, because it's almost a case of throw out the textbooks. I mean, in Australia, we've got, a 20 plus, 22, 23% loan to value ratio across the residential market. A lot of people don't have debt on property in Australia.
And those that do have a very small debt, Graeme. And, when we compare, and I've seen some reports comparing the affordability declines, now versus a year ago because of higher interest rates. But what those models forget to measure is we've had, a 3% plus per annum growth in incomes. So even though interest rates are rising, so are incomes, Graeme, because this is a very strong economy. So that gives those mortgagees some capacity to absorb those higher rates and, as well as other factors such as high savings rates they're falling, but they're still quite reasonable. And of course, a lot of wealth that's been generated through their asset booms of the last couple of years. So I think that's one of the factors why people are still out there spending like drunken sailors. They feel it's a very strong economy.
And we are spending like drunken sailors. It hasn't slowed down, that's for sure. Rates have gone up. The credit cards are still clanging through the teller machines and the merchants, and people are still buying Gucci shoes with bees on them and dining out. And I think there's still a bit. I think, Doc, we've talked about this before. There's still a bit of. We talked about pent up demand in the housing market. Like Melbourne and so forth, when you couldn't even inspect a home, and Melbourne's recovered pretty strong, but there's also this pent up demand for travel and retail and hospitality and dining. There still seems to be a lot of pent up demand for life in general, and retail goods.
100%, Graeme, and particularly travel. And travel was a big contributor to inflation over the December quarter. I think people, certainly were sobered by the lockdown experience. And now it's like, well, we're out of that. Let's make up for what we lost. Let's get out and about. Let's enjoy life. And we're seeing a surge, not just in interstate travel, but in international travel. And we know, those airline costs are pretty high at the moment if you're traveling between.
I reckon if you could buy stocks right now, the airlines are a sure thing, because what was $10,000 to go to, say, America from Australia is about $50,000 now.
Well, it's the same if you're travelling to Melbourne to Sydney, Graham.
True.
Everywhere, and this is about volumes to a significant degree. More people are travelling, and I think it is that pent up demand, that sense that we're free now again, relatively, and let's do those things that we couldn't do during lockdown, and which was very severe, of course. Let's admit that, particularly in Melbourne and Sydney. So with a raging economy, a booming economy, it's you have the capacity to, at least feel that you're experiencing some level of prosperity.
Mm. Well, let's have a look at the data this week, Doc, and see what's factually happening. Let's have a look at that.
Well, thank you, Graeme. And as I mentioned before, it's, the data never really stops coming through. And we'll start with the economic data and the rate outlook. Of course, last week we had that increase from the Reserve Bank to start the year, the first meeting since last December. The Reserve Bank, probably not surprisingly, decided to increase the official rate by 0.25%. We've had a rate increase every month since May, so this is an unprecedented sequence of rate increases. We've tracked back from those 0.5% increases we had last year towards the middle and the end of last year, and now we're using that base increase of 0.25%. I think that there was probably some discussion over the past month or through the holiday period from the Reserve Bank about maybe we could pause in February. But I think those inflation numbers which came out for the December quarter were sobering. I think that they were worse than expected. And I think that, really none of the other major data sets, the labour market wage increases haven't really given any real indication that higher interest rates are working. So, you've got to keep with the plan, man, and up with another rate increase. And I think that that's pushed out the peak of this rate increase cycle by at least one rate rise. And I think there are going to be some very hard questions asked of the bank over coming months, whether this is worth continuing if there is really no substantial impact being revealed. I mean,
that's a really core statement there, Doc. I mean, if rate rises aren't having the impact traditionally that they should, does that mean the textbooks are out the window finally?
Well, if they're not working, they're not working. I mean, you get to the stage, of course, where you keep putting up rates until you crack the economy. That's what we experienced in the 90s. And that leads to a severe economic downturn. And then that takes years and years to fix, as we learnt through the 90s. And, it's really a terrible environment to be in when you can't find a job. And we're talking about, upwards of 10% plus of the population being out of work or of the workforce not having a job. And these are very difficult factors to fix, as is the high inflation rate environment is difficult to fix. So it's a juggling act. And as I said, those hard questions are going to come if we don't see any signs of, inflation falling and the higher interest rates by the Reserve Bank doing their job. And we have to say clearly, Graeme, that we haven't seen really any signs so far, and we're just as far away probably from fixing inflation as we were when we started increasing rates back in May last year. And you've got to remember, we put up rates last year by 3%. Official rates increased by 3% last year, Graeme. I think as we stand now, being an optimist, maybe we have a 1% increase this year. But that's predicated on, the policies working. And we have to say that it hasn't worked so far. But the saving grace for everything and why our economy, consumer spending, our housing markets are still doing okay is because we're in the middle of this remarkable booming economy. I don't even know if we're in the middle of it. We might be at the beginning of it, but it's certainly sustaining economic activity and really offsetting the impact of higher interest rates.
Well, I'll tell you who's booming at the moment, Doc. The big four banks that have to be booming with all these interest rate rises based on what they lent money out a couple of years ago to where we are now.
Yeah, absolutely, Graeme. I think the banks are being a little circumspect in their lending. In these times of, I guess, uncertainty, particularly in housing markets to some degree, well, I think that's overstated. Banks are probably a little bit more reticent to lend. It's part of their risk management strategy. I think that's why we're still seeing housing loan numbers falling away. But that's just part of that capacity that banks have to manage their book. And I think they're doing that now by just, being a little wary about their lending policies, while, there is some doubt about housing market activity. But the real data is showing that that the housing markets are up and about, and we'll certainly look at that shortly. But yeah, the rate decision over February, up by 0.25%, 3.35% now. The Reserve Bank is obviously wary of creating an economic downturn through higher rates, but it was adamant in its statement that it made on the day on the February Tuesday they increased rates, that they were very much still committed to controlling inflation. In fact, Graeme, I think that was the key point, and we have to read between the lines, is that the decision really reinforced in the small statement that the governor made, was that they are really focusing on inflation. So there wasn't any, discussion of maybe we'll go into a pause. It was we got to keep going here.
Not that the board's prepared to be patient. It's we're going to control it. We're committed.
Well, that's it. So that's the big picture. I think that did reflect that they were disappointed in the latest inflation data, really not showing any significant signs of working, higher interest rates. More increases likely to come. Are we nearing the peak? Well, I think we are, but I think we're still got some work to do before we can really see that peak on the horizon, Graeme.
I mean, unless we all collectively stop spending, you've got to think there's another 0.5%, 1% suddenly before the end of the year.
Well, that's right. And I think now we're headed over 4% where we land, maybe just over, but we need to be guided as the data comes through, as the Reserve Bank will be, and that's the inflation data. Wages data out next week, Graeme. Very interesting to see that, and we'll discuss that when it does come out. We're currently increasing annually at 3.1%. That's September quarter data, so that's a long time ago. And the December quarter data will come out over the next week, and that will show us. And I'm confident that will show quite a surge in wages over the December quarter. But that's not great news for the Reserve Bank, because if we are paying ourselves more, it gives us more money to spend, which keeps the bubble going. In terms of higher prices, and of course the labour market data, which will be out at the end of this week. Even though the unemployment rate has been steady at 3.5% now for a couple of months, which is an all-time monthly low, and maybe there are a couple of signs that we've peaked in terms of our labour market performance. We lost a few jobs, but mainly they were part-time jobs, and that can be put down to the November loss through the Black Friday boom into December. So, yeah, maybe it didn't really mean that much. And so there's really nothing even in the labour market data to show that the economy is slowing down at any level. And the Reserve Bank meets again on March the 7th, and they'll have that wages data to look at, and the unemployment data. But, there's absolutely no sign that their job's being done. So you'd have to say they've got to keep going, But we had that inflation data out of the US out today, Graeme, hot off the press. There was a little bit of a fall there, 6.4% to 6.5%. So similar for their underlying inflation measure, down from 5.7 to 5.6. So there's nothing really to get excited about. In fact, most of those falls were because the price of oil has fallen. So
everything else went up, right?
That's right. In fact, their monthly figures weren't that encouraging, because fuel, again, on the monthly scenario, it increased. Housing, mainly rents and clothing, increased over the month. So even though the annual data was a little better, it was based on the reduced price of oil on a year-by-year basis. And I think it's interesting, Graeme, the big problem the US has is goods. It's not goods anymore. Goods were driving inflation initially because we had all those supply roadblocks through COVID. That's now generally being fixed up. So the issue with higher goods prices, because we couldn't get enough of them for high demand. It's now about services, and those services are being driven clearly by strong wage increases. And just as an example, US wages are up 6.3% over the year, Graeme. We're up 3.1%. Now, that's a big, big difference, and that's clearly working into their inflation rate in terms of higher services prices. Now, the US have had put rates up by 4.75% over the past year, and really, even though their inflation rate has fallen away, it is about getting in control of those supply side roadblocks. But now they're being fueled by the big fear, which is higher wages pushing higher prices, which in turn higher wages and higher prices, and on we go. And I think the interesting thing, Graeme, is when we look at the US inflation versus Australia's inflation, we're actually about a percentage higher at the moment, despite the fact that we're not, although we are starting to see signs that services costs are rising here, we're not seeing them rise at the same rate as the US. But I think the big difference in our rate, or one of the big differences, is our high house building costs because of the home builder policy that was introduced by the previous government in early 2021. We know they've gone through the roof. And the bad news, Graeme, is that we've actually started to see a surge again in house building costs. And this is a big problem, for development, for our housing markets, providing enough supply. So we saw another rise over December. This is the My Housing Market House Building Cost Index. And when we look at the annual growth rate, we've picked up again to 18.8%. That's not a good number when we see building costs rising over the year by house building costs by 18.8%, which is getting back up to that record level, which was in the mid-20s. But we're certainly well ahead of, where we were pre-COVID. And this is a problem because, if we could stabilise building costs, that would be a positive. But if they're rising again, Graeme, it's only going to work into inflation. It is a significant factor. And it's only going to make it tougher for the Reserve Bank going. I
don't think it's going to get any cheaper to build anytime soon.
No, and those that have put through building approvals, and building approvals are certainly nothing to get excited about, Graeme. But even though
starts and completions are probably a bit more important than approvals, because not many are getting started.
That's the problem, Graeme. Of course, that even though, as I said, approvals aren't anything to get excited about, they're back to pre-COVID levels. And certainly apartment approvals are way below where they were in 2015-16. But the problem now is the proportion of building approvals, residential building approvals that translate into commencements or completions. Well, commencements will be a lot lower than we're used to. Typically, it's around 95% of approvals turn into commencements, but I think we're going to see a lower proportion because those approvals, builders are struggling to go ahead because of the extreme cost increases that have been occurring. So these projects just aren't profitable, or some of them. And of course, we've had the latest rent data, and all this undersupply environment, Graeme, is, again, revealing itself in our rental markets. No relief. This is interesting, Graeme, because this is the January data, latest data. Sydney's still the top performer there in houses and units. But when we look at the change over the month, this is quite remarkable. Now, you've got to understand, Graeme, that January is typically a quiet month for the rental market. In fact, it's the quietest month of the year. No surprise, because it's holiday season. It's the big holiday of the year. And there's certainly a collapse in people looking for somewhere to live. No surprise, too busy holidaying. So we do see typically an easing in rents or stabilising in rents, and a rise in vacancy rates over January. It's a very strong seasonal effect. Didn't happen in Melbourne and Sydney this year, Graeme. In fact, we saw rents for houses rising in Melbourne and Sydney, which is quite remarkable, and not just rising, certainly in Sydney, rising quite steeply over the month compared to the previous month. No surprise, Brisbane and Adelaide down a little bit, but I think that's that seasonal impact that we're used to. But even Perth rents rose. And when we look at units, same deal. Sydney and Melbourne, rents rose over January for units in Sydney and Melbourne, up in Adelaide as well. And I think Brisbane's the only market that showed what we would expect in terms of a holiday season. And this is just reinforcing the problems that our rental markets have, particularly our big capitals there in Sydney and Melbourne, with rents still rising despite all those holiday distractions. And I think that's a particularly sober, a statistic. And of course, over the year, this is crazy stuff. Look how rents have increased over the year, Graeme.
It's insane, Doc, but it's also in line with value increases over the last year or two in these suburbs as well.
Well, that's right. And Brisbane, quite remarkable, 27.8% increase in house rents. That must put a shudder through tenants, through tenants seeing those sort of numbers. And Sydney and Melbourne unit rents up over 20%. Now, that's coming from a lower base. We know that because there were higher vacancies in Melbourne CBD area, particularly for units, and Sydney's inner suburban area, particularly the south of Sydney, had a high vacancy rates, but that's coming. Those vacancy rates have come down with a thud, and rents are going through the roof. And it's catch up, but certainly it's catching up very quickly, particularly Melbourne at the moment, where unit rents, are coming from a low point to a much higher point very quickly. And no surprise, vacancy rates are still very low for houses, Graeme. We saw the Sydney house vacancy rate just pick up a little bit over January, which went against, I guess, those higher rent trends. But anything under 2.5% is a market that's leaning towards landlords. And to be basically under 1% everywhere just shows how tough it is to find a vacant property in the big capitals. And, of course, units similarly, only Melbourne is above 1% significantly. And as I said, that was at around 6% not that long ago, Graeme. So it's being soaked up, dramatically at the moment. And it's just more data that reinforces the tough times that we have in our rental markets at the moment. And that can't improve, particularly with that dearth of supply coming through, constrained by so many things, and now clearly constrained by high home building costs. I just thought we spoke about the banks just before, and I think too, there's been a lot of chat about, all those that refinanced a couple of years ago, taking advantage of those very low fixed rates that were on offer. We saw a surge in refinancing then. Some of those rates were like 1% or, very, very low. And of course, they were locked in. But now the problem is that those who did lock in those low rates are faced with refinancing this year sometime perhaps, where they're going to have to pay a lot more than 1%, let me tell you. So, of course, there's a lot of chat going around, what's going to happen to the housing market if these people can't refinance? Well, they will refinance. And that's what we're seeing with the latest data, is there's still a surge to refinancing. And I think perhaps a lot of those that took that very low rate a couple of years ago, Graeme, are now thinking, okay, well, I'm going to get in early now, get myself a new deal, and avoid this so-called cliff, which is, again, the media fantasy. Another cliff. How many cliffs have we had that have just disappeared into fairyland? I think that's a sign that, with refinancing, even though it was a little lower over December, when we look at the market share, and this compares refinancing to overall new loans for owner-occupiers, we can see that that's at a record level. So the actual measure in terms of the market share for refinancing rose to a record level over December. And I think brokers are sort of, hand in hand with their clients now. They're working them through, the issue of when they do have to refinance. With those,
some people, they stay in this low rate, Doc, or appears to be low. They might get priced out of a refinance at all. So I know we've worked with a lot of customers saying, hey, 2.2 looks great and 4 or 5 scary, but another 3 rate rises plus a buffer, the bank won't let you refinance. So let's do it now.
Yeah, that's right. I think those numbers are telling us that, Graeme. And that's why I think that we won't see any, as we were going to see anyway, we won't see any real impact from this year from those unable to refinance, because I think, most will refinance. And you've got to remember that over the last 2 or 3 years, wage earners are probably 10% better off, and their assets worth more as well. So, it's a good story, but you don't have to look too deep to sort of shred it in terms of its credibility. No. But I just thought that was an interesting data set that shows that, the refinancing is still well and truly underway. But I do think it's now being driven to some degree by those that are wanting to get in early, that refinanced a couple of years ago with those low rates, and are being prudent enough to take advantage of the market at the moment. And of course, it's within the interest of the banks and the brokers to get the refinancing deal done. How do they make their money? And as I said, I think it'll be a blip. And as you mentioned at the very beginning of the show, Graeme, most homeowners, owner occupiers, don't even have a mortgage. And then
it's only 22. It's early 20% of the population have a mortgage. Of the residential housing market in Australia, trillions of dollars.
Yeah,
so
and
22%.
And half of those have a low balance, Graeme.
Yep.
And of course, everybody who has had a home over the last few years has benefited from skyrocketing house values. So
if you look at a baby boomer doc in Sydney with a multi-million-dollar home in a good suburb that's not ready to downsize, they might owe 200 or 300. But when you've got $2 million homes owing 200,000 or 300,000, you're pretty okay.
And it's a booming economy, Graeme. Everybody who wants a job's basically got a job. And, the boss is doing anything he can to keep you. So, you've got all the leverage to get a higher wage. When that latest wages data comes out, I think we'll be heading towards at least 3.5% growth over the year, which will be the strongest result in a decade. Over the last 3 years, we've seen wages increasing by, up to 10%. And that, of course, helps to offset those increased mortgage costs. So we'll see what happens. But again, I think this will turn out to be just another, nasty bedtime story.
It'll be the 597th cliff we're supposed to have fallen off in the last 30, 40 years that we didn't.
So many cliffs. And of course, as we always do, Graeme, we'll have a look at the latest auction results. And these are very interesting. Of course, we've started off the year now. We're in our second weekend of auction results. The resurgence is continuing. These are the results from last Saturday. We certainly had a lot more auctions, no surprise, second week of February. A couple of hundred more auctions in Melbourne and Sydney compared to the previous weekend. Look at that Sydney result again, 70%, Graeme. That's
unbelievable.
Well, it's back-to-back 70% from good auction numbers here. Agents are telling me, and as they would perhaps, that, they're getting plenty of attention on their stock at the moment, plenty of competition, and 70% clearance rates certainly are reflecting an emerging seller's market.
And also almost double last Saturday's 70% off, from mid-threes to mid-fives.
Right.
There's an extra 200 properties there that have cleared.
And I think
for auction.
And I think, Graeme, that this was a test for the market. Yeah, okay. So we started off the year with a couple of big results in Melbourne and Sydney. Would it hold up when we had more listings coming through? Well, yes, it did. Melbourne was down. But again, as the market moves on, we get more listings, and there will be a lot of listings coming through, particularly in the Melbourne market. And that will certainly continue to test these very positive early season results. But the reason that we call it a resurgence, Graeme, when we look at a year ago, of course, those clearance rates are lower than a year ago because we were still booming. We've got to remember, a year ago, we were just a very strong boom time housing market across the board. But those clearance rates had started to fall a year ago. They were now, Melbourne and Sydney under the 80% levels that they had been in late 21 and early 22. But what the real comparison is, Graeme, is when we look at where we left off last year. Now, our auction clearance rates in Melbourne and Sydney are, in Sydney, it's around 10% higher than where it was when it left off at the end of last year. And, typically our clearance rates are around about, or start the year off around about where they left off in December. And we've started the year off much higher, of good numbers of properties. This isn't just a handful of auctions here, good numbers of auctions, and this will work its way into confidence. Brisbane, we had a few more results through, we had quite a number of reported auctions the first weekend. We had a few more reported results and a much more rational clearance rate. Adelaide's still very strong, and Canberra picked up as well. So this is clear, data-driven evidence, Graeme, that our markets are picking up. And of course, next weekend, we get another go at it. It's another, game day, Saturday, and we'll see what happens again. But again, there'll be a lot more auctions coming through.
I'll tell you what, Doc, if we've had another rate rise this week, we go to auction and we have strong clearance rates, 65, 70s again next week. That tells you that we're still spending like drunken sailors. We've still got borrow, and interest rate rises are not stemming our economy or the inflation we're experiencing.
Or the housing market. I mean, the big question was when the Reserve Bank increased rates in its first meeting of the year, what would happen to the auction markets? Well, there are the results, Graeme. You tell me there was any impact there. Only the Melbourne market was really lower over the week, and still produced a clearance rate ahead of where it finished the year last year. And we'll watch out for that Melbourne market this year. I'm pretty positive about the Melbourne market's prospects this year.
Yeah.
So again, we'll wait and see. But gee whiz, so far so good. You just can't argue that. And we know that auction clearance rates are a good early indicator or forward indicator of what's happening when we compare them to house prices. That's certainly a very strong relationship there. And we can look at the long-term relationships or the long-term over the past year monthly results. And you can see they're well ahead, Sydney, of where it landed last year. And at the highest levels really since March last year. That's a long time ago. Melbourne, again, well ahead of where it finished last year. Still below a year ago, but not that far below where it was a year ago, Graeme. Brisbane picked up at the weekend. It's around about where it was last year. Adelaide strengthening, again higher than where it ended last year. That's the resurgence scenario. And similarly, Canberra's tracking higher than where it finished a year ago. And of course, as we tell everybody, if you want those auction clearance rates, get onto my LinkedIn channel of a Saturday night. 6:30 they come through, and then first thing Sunday morning you get the regional results. And that's the data for this week, Graeme.
Well, there you have it, Doc. I don't know where the doom and gloom is. The data's quite delicious. Just give it another D word.
Yeah, look, it is
scary.
Well, the housing market and has really for the last 6 months or maybe longer shrugged off higher interest rates. We've had an interest rate increase every month except January when they're all on holidays, every month since May, Graeme, every single month. And we saw markets rebound over spring, and we've had a very inarguably positive start to our auction markets this year. And I think we're inside of the bottom in Melbourne and Sydney, and but in terms of house prices, but certainly the positives are there. The only negative is we're likely to see more interest rate increases, but at the same token, we're likely to see more wage increases, and not too far down the track, we're going to see house prices increasing as well, Graeme. So that's adding to household wealth and income.
The big call, Doc. House price increases in 2023.
Yes, mate, but, and not that far away, I think, from happening. And we haven't even mentioned the M word, which is migration. What's that going to do to the whole situation?
Well, let's not give too much away this week. There you have it, ladies and gentlemen. Tune in next week. Big week next week. Bit more detail, bit lengthier, and also you'll start getting some of the quick fire chats and rants that you've asked from Doc and I each week as well. So there you have it. Give a big thank you, Doc, as always, and we'll see you next week.
Yeah, great stuff, Graeme. We'll have wages data, unemployment data, and that very interesting auction market data to discuss.
Data. There we go, folks. See you next week.